if a distressed asset is a distressed asset in a global sense, why do we not see the same amount, either in absolute terms, in percentage terms, of distressed assets in Europe? Isabel, why do you think that seems to be the case?
I think it's just because all those distressed assets, or most all of them, are in the hands of banks, and at present time banks have not started to deal with those issues. They are sitting on their books, trying to postpone the issue, renegotiate the loans, extending them, and they clearly don't want to cut additional losses, so they are postponing all those issues, and they have not started to sell their book, and selling those books would require for them to cut significant amount of losses, something they are not ready to do. So probably it will come, but it's clearly, for me, in the hands of banks, which are sitting on their hands, doing nothing, preferring, and their objective is clearly to spread their losses over the longer period as possible. So if there is still some room under those complex structures to go to renegotiation, extending the loans, it's something they are doing today.
Right. And Thierry, do you think that banks or lenders in general operating like this, is this the most efficient way, or is it the most clever way, effectively? I don't know. Are they buying time in order to expect something based on an improvement of the macroeconomic environment? And in that sense, is the US market more dynamic because it reacts in a sharper sense sooner? What do you think about that?
Well, I would certainly not comment on the cleverness of the bank. I mean, I'm sure there are pretty clever people. But to your point, it's true that in Europe, a lot of banks have already taken a lot of losses. I think there's a level at which, frankly, acknowledging losses, as Isabel was saying, day one might be a bit painful. There is also obviously the Basel II requirements, which, given when you add both the probability default, the loss given default, also with the market risk, the three risks that you monitor, if the banks were forced to actually acknowledge what is potentially their true LTV, it would be exponentially difficult for them in terms of capital requirements.
Right.
Because as you know, above 70%, it's brutal, the capital requirements. So I'm sympathetic with the bank's view, which is to say, well, the markets may actually be rebounding. Maybe we dropped significantly very quickly. We already see signs actually potentially of, both, as Bromme was alluding to, there is a modest recovery coming up. Maybe the rents will stabilize. Maybe, the cap rates will start recompressing. We've certainly seen that in the prime assets already. So for the banks to frankly say, I'll ride the cycle until such time as actually either I mitigate my loss or I don't have capital requirements, which would be too punishing for me, makes a lot of sense.
Over to you, Shoy. Do you see that, is there any particular sector that seems to be more in favor in Japan?
I think, if investors take a chance or risk, obviously, distressed sectors like hospitality industries, and also, I should say, some retail, industries. Basically, there are certain distressed potential seller of the hospitality properties. And compared with the reconstruction cost of one hotel, the acquisition cost is pretty much lower than the reconstruction cost. And when the economy turns around, basically people are willing to pay double or triple for the accommodation. But at this moment, people are not willing to travel and not willing to pay a lot of money. So this means there will be a certain volatility expected, higher margin for these things when economy recovers. Mm-hmm. But it is difficult to say when the economy really recovers in Japan. But if investor wants to make money, hospitalities and some retail sectors are interesting. And also, I would like to mention, not talking about the sectors, but I think the investor should look at each situation of the particular transactions. people should look at good properties, but with a distressed seller. And even the property is good, sometimes certain seller has certain reason to sell the property.
Over to you, Bromme. There's been quite a lot of discussions or even questions as to if we assume that there is a distressed asset market out there and developing, how the hell do you provide valuations? And how are valuations done? So if I'm a buyer wanting to go and buy that distressed hotel or the debt on it, how do I go about valuing it?
I'll speak to some of the transactions that I've seen, and that is that you approach it from, you would underwrite the office building, you would value the hard asset from the point of view of what are the actual rents in place. You need to assume that there is really not going to be any serious increase in vacancy for some time, and you underwrite really existing cash flow, and you mark to market all the existing rents. Some people may find that a bit too punitive, but that's really the way I mean, it's really a very sobering way to take the approach to valuation. And then you come up with a new value for the building, and then you assume a market rate of debt on that, that valuation. And so that debt, very well may look like a 40% or 50% haircut to the existing piece of debt. It may even be, even be more.